In late 2023, a single oil tanker left Venezuela's Jose terminal under a new U.S. approved license. There was no press conference, no presidential tweet, no flag-waving photo op. But in the corridors of Houston, Geneva, and Washington, the message was unmistakable. The United States had quietly flipped the switch on Venezuela's oil. Sanctions that had frozen $2 trillion in oil assets for years were suddenly, selectively eased. American and European energy giants received quiet approvals to resume shipments. Insurance companies, once terrified of U.S. penalties, began to underwrite Venezuelan cargoes again. The world's most sanctioned oil was now flowing, legally, into American refineries and global markets. On the ground in Venezuela, the change was immediate. Idle tankers were reactivated. Engineers returned to mothballed wells. Dollars trickled back into PDVSA's accounts. In Maracaibo, oil workers who had been paid in food boxes now saw real wages. The government, desperate for cash, struck deals with foreign partners on terms that would have been unthinkable just a year before. But the real shift was happening far from Caracas. In Beijing, Chinese oil traders found their unofficial routes, once the lifeline for Venezuela, crude, suddenly tangled in red tape. Shipments faced unexplained delays, insurance premiums spiked, political pressure mounted. The same tankers that had quietly moved oil east for years now found themselves shadowed by new compliance checks and diplomatic warnings. This wasn't announced, it was executed. One oil license quietly rewired global energy flows. The U.S. didn't just open the tap for itself, it squeezed the hose for its rivals. The world's energy map was redrawn not with speeches, but with signatures on regulatory waivers and whispered calls to shipping desks. The emotional echo was sharp. The oil embargoes of the 1970s, the panic of 1929, the uncertainty of every modern energy crisis. Each time, leaders promised stability. Each time, the rules changed and the dominoes fell faster. The contrast was stark. While American refiners quietly ramped up, Chinese buyers scrambled for alternatives, and the price of oil in Asia ticked higher. This move wasn't about Venezuela, it was about who loses access next. Venezuela's oil isn't just another commodity on the world market. It's a strategic asset with outsized influence. The country holds the world's largest proven oil reserves, a staggering 300 billion barrels, more than Saudi Arabia or Russia. But it's not just the size that matters. Venezuela's heavy, sulfur-rich crude is uniquely suited for the complex refineries China has spent billions to build. For years, Chinese energy giants have relied on this oil to keep their plants running at full tilt, blending it with lighter grades to maximize output and profits. In 2024, China's energy map is more fragile than it looks. The South China Sea is a geopolitical minefield. The Strait of Malacca, through which most of China's imported oil flows, is a choke point vulnerable to U.S. naval power and regional disputes. The Middle East, once a reliable supplier, is now a patchwork of risk. War in Yemen, tension in the Gulf, and the ever-present threat of sanctions or sabotage. Russian oil, once a fallback, is tangled in its own web of sanctions and logistical headaches. For Beijing, Venezuelan oil is more than a bargain, it's a lifeline. It's a source of supply that bypasses the world's most dangerous shipping lanes. It's a hedge against Middle East volatility and a way to diversify away from U.S.-controlled routes. But when U.S. policy quietly reroutes Venezuelan crude to American and European buyers, China's options shrink. The loss isn't just barrels, it's certainty. Energy security today isn't about abundance, it's about certainty. China can't just replace this oil. Every lost shipment from Venezuela means more exposure to the world's most volatile regions. Every new deal with Iran or Russia comes with higher costs, more risk, and more political strings. The emotional echo is clear. The panic of the 1970s, the scramble for oil in every crisis, the realization that dependence becomes dangerous when options disappear. And Washington understands exactly where China's energy pressure points are. In 2019, Venezuela OS oil exports to the United States dropped to zero for the first time in nearly a century. The world saw headlines about maximum pressure sanctions. But behind the scenes, the U.S. Treasury was already drafting a new playbook. The old strategy, total isolation, had failed. Venezuela's government survived, oil still flowed to Asia, and black market networks thrived. The embargo had created chaos, not collapse. By 2022, Washington's approach shifted. Instead of blanket bans, the U.S. began issuing selective licenses. Chevron, Repsol, and a handful of other companies were quietly allowed to resume operations in Venezuela under strict conditions. Every contract, every shipment, every dollar was tracked. The message was clear. Access to Venezuelan oil was now a privilege, not a right. This wasn't sanctions relief, it was oil probation. The U.S. could turn the tap on or off at will. Licenses were temporary, subject to review, and could be revoked overnight. Companies had to prove they weren't funneling cash to sanctioned officials or using banned intermediaries. Insurance, shipping, and payment systems all required U.S. approval. The result was a new kind of leverage. Washington didn't just block oil. It decided who could legally touch it. The impact was immediate. European refiners, desperate for heavy crude, lined up for licenses. American companies returned to fields they'd abandoned years before. The Venezuelan government, starved for cash, accepted deals on terms it once would have rejected. Oil production stabilized, but only within the boundaries set by U.S. regulators. Meanwhile, China's options narrowed. Tankers bound for Asia faced new compliance checks. Insurance premiums soared. Banks hesitated to process payments, fearing secondary sanctions. Even Russia, once a reliable partner, found it harder to move Venezuelan oil without tripping over U.S. rules. The shadow market shrank as legal channels reopened on Washington's terms. Access became a privilege, not a right. The U.S. had learned from past failures. Control was more effective than confrontation. By managing the flow of Venezuelan oil, Washington could reward allies, punish rivals, and keep a hand on the global price dial. The emotional echo was sharp. The embargoes of the 1970s, the chaos of the 1980s debt crisis, the uncertainty of every modern energy shock. Each time, leaders promised stability. Each time, the rules changed and the dominoes fell faster. The contrast was stark. While American and European refiners quietly ramped up, Chinese buyers scrambled for alternatives, and the price of oil in Asia ticked higher. And every new rule quietly narrowed China's options. For years, China's energy giants had mastered the art of moving sanctioned oil. When the U.S. first slammed the door on Venezuela, Beijing didn't blink. State-owned refiners rerouted tankers through Malaysia, Singapore, and the Caribbean. Oil changed hands at sea, paperwork was rewritten, and payments slipped through a maze of offshore accounts and digital wallets. The world called it sanctions evasion. In China, it was just business. But by 2023, the game had changed. The U.S. wasn't just blocking oil, it was deciding who could move it and how. Licenses for American and European companies meant that the safest, cheapest routes were now reserved for Washington's friends. For Chinese buyers, every barrel became a gamble. The first sign of trouble was in the insurance market. Lloyd's of London and other major underwriters, wary of U.S. penalties, began refusing to cover tankers carrying Venezuelan crude to Asia. Without insurance, a single accident could mean $1 billion loss. Ship owners hesitated. Freight rates soared. Some captains refused the job altogether. Next came the intermediaries. Swiss traders, Singaporean brokers, and Caribbean shipping agents who once thrived on moving gray market oil started pulling back. The risk of being blacklisted by U.S. regulators was too high. Banks froze payments. Letters of credit were denied. Even Russian partners under their own sanctions found it harder to move oil without tripping over new compliance rules. The result was a slow-motion squeeze. Oil still flowed from Venezuela to China, but every step was costlier, slower, and more dangerous. Tankers ran dark, switching off transponders to avoid detection. Crews faced longer voyages, rougher seas, and the constant threat of seizure. The price of Venezuelan crude in Asia rose, not because of scarcity, but because of risk. Oil isn't valuable if you can't move it safely. Sanctions don't stop oil. They decide who bears the risk. For China, the cost of every barrel from Venezuela was now measured not just in dollars, but in insurance premiums, legal fees, and political headaches. The emotional echo was unmistakable. The oil embargoes of the 1970s, the chaos of the Iran-Iraq War, the uncertainty of every modern energy crisis. Each time, leaders promised stability. Each time, the rules changed and the dominoes fell faster. The contrast was stark. While American and European refiners quietly ramped up, Chinese buyers scrambled for alternatives, and the price of oil in Asia ticked higher. And Venezuela was only one piece of a much larger energy chessboard. In the wake of the U.S. oil pivot, the shockwaves didn't stop at China's ports or Venezuela's battered refineries. The entire global energy market began to shift beneath the world's feet. In Mumbai, Indian oil executives gathered in war rooms, recalculating supply risks. For years, India had quietly relied on discounted Venezuelan and Russian crude to keep its refineries humming. Now, with U.S.-approved tankers crowding out shadow shipments, India's options narrowed. Every new contract came with a question. Will this shipment clear, or will it be flagged by a Western regulator? OPEC ministers watched nervously from Riyadh and Abu Dhabi. The cartel's power had always rested on its ability to manage supply and set prices. But now, the real power was shifting to those who controlled access, who could grant or deny the right to move oil across oceans. The old game of quotas and production cuts was being replaced by a new game of permissions and alignments. In Geneva and Singapore, energy traders scrambled to price in a new kind of risk. It wasn't just about hurricanes or refinery fires anymore. Every barrel now carried political weight. A single rumor about a new U.S. license or a Chinese compliance crackdown could send prices swinging by dollars in minutes. The geopolitical premium was no longer a footnote. It was the main event. The emotional echo was everywhere. The panic of the 1970s, the chaos of the 2008 oil spike, the uncertainty of every modern energy crisis. Each time, leaders promised market stability. Each time, the market discovered that stability was just another word for permission. Energy markets were becoming loyalty tests. Who you bought from, how you paid, and which routes you used all signaled your place in the new order. For some, access to oil was a reward for alignment. For others, it was a punishment for defiance. But oil was only half the story. Currency power was the other. In 2024, the world's oil tankers didn't just carry crude. They carried the weight of global finance. Every U.S. license, every sanctioned shipment, every rerouted barrel was a move in a much bigger game, the defense of the dollar-S empire. As the U.S. quietly reopened the tap for select companies, the message to the world was unmistakable. Oil deals would be done on Washington's terms in dollars through approved channels. The shadow market shrank. The petrodollar's grip, loosened by years of sanctions and alternative payment experiments, suddenly tightened again. For China, the lesson was harsh. Every attempt to pay for Venezuelan oil in yuan, gold, or cryptocurrency ran into new obstacles. Banks hesitated. Insurers balked. Even the most creative workarounds, blockchain invoices, barter deals, ghost tankers, became riskier and more expensive. The U.S. had turned oil access into a loyalty test for the global money system. In Geneva, traders watched as the spread between dollar and non-dollar oil contracts widened. In Moscow, officials grumbled that sanctions on oil were now sanctions on currency. In Riyadh, OPEC ministers debated whether to keep pricing oil in dollars or to hedge their bets with yuan and euros. The emotional echo was clear. The panic of the 1970s, the currency crises of the 1990s, the uncertainty of every modern financial shock. Each time, the world's leaders promised market freedom. Each time, the rules changed and the dominoes fell faster. This wasn't an oil deal, it was a currency defense. Control the oil flow, and you influence the money system. The U.S. had learned that lesson in the 1970s, when the petrodollar was born. Now, it was using the same playbook to contain rivals and reinforce its own dominance. But the cost was real. Allies grumbled about weaponized finance. Rivals doubled down on building alternative payment systems. The world's energy and money systems became more fragmented, more politicized, and more fragile. So did anyone actually win this oil war? No invasion, no collapse, no dramatic announcement. Yet, in less than a year, the balance of global energy power shifted. Venezuela, battered by years of sanctions and economic collapse, gained limited breathing room. Oil workers returned to the fields, dollars trickled back into the economy. But every deal came with new strings, terms set in Washington, not Caracas. The United States, without firing a shot, regained leverage over a key oil supplier. By controlling access, licenses, and insurance, it quietly rewired the world's energy flows. American and European refiners ramped up, while rivals scrambled for alternatives. The petrodollar's grip, once thought to be slipping, tightened again, at least for now. China, for all its economic might, faced a quiet, strategic setback. Its shadow shipping routes grew riskier, its payments grew costlier. Its energy security, once built on diversified supply, became more vulnerable to the stroke of a pen in Washington or a new rule in Brussels. The emotional echo was unmistakable. The oil embargoes of the 1970s, the chaos of every modern energy crisis, the realization that the world's most valuable resource is now rationed by permission, not just price. The lesson is clear. Modern economic wars are fought through access, licenses, and pressure points, not tanks. Every barrel now carries political weight. Every contract is a test of loyalty. The next oil war won't start with missiles. By the time markets react, the move is already over. The world didn't witness an oil war. It lived through one silently.